Preparing for a finance manager at Verizon interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to be a finance manager at Verizon. I am a finance professional who combines rigorous analysis with practical business partnership. In my recent role, I owned forecasting, performance reporting, and investment decisions while leading a team through tight deadlines. Verizon appeals to me because telecommunications finance connects recurring revenue, customer behavior, technology investment, and operating efficiency. I would bring disciplined planning, clear communication, and a bias toward actionable insights. My goal would be helping leaders make faster, better decisions while developing a high-performing finance team. While answering, focus on your finance progression, leadership experience, operational partnership, interest in telecommunications, and how your skills support Verizon's customer, network investment, profitability, and cash flow priorities. Question 2. How would you build an operating forecast for Verizon's wireless business? I would build the forecast from operational drivers rather than simply applying historical growth. I would model subscribers by opening base, gross additions, churn, and retention, then calculate service revenue using plan mix and ARPU. I would separately forecast equipment revenue, commissions, network costs, marketing, labor, and capital spending. I would validate assumptions with sales, marketing, and network leaders, then present base, upside, and downside cases with sensitivities that explain earnings and cash flow impact. Make sure to cover driver-based modeling, subscriber additions, churn, ARPU, device activity, service revenue, costs, seasonality, scenario analysis, and alignment with commercial and network stakeholders. Question 3. Which key performance indicators would you monitor for Verizon? I would monitor both customer and financial indicators. Customer metrics include gross additions, churn, net adds, ARPU, upgrade rates, and customer acquisition cost. Financial measures include service revenue, EBITDA margin, operating expense, capital intensity, free cash flow, and return on invested capital. I would not view any metric in isolation. For example, aggressive promotions may improve net adds but weaken ARPU and cash generation. The finance manager's role is connecting operational movements to sustainable economics. In your answer, talk about subscriber growth, churn, ARPU, net adds, revenue, EBITDA, margin, customer acquisition cost, capital intensity, free cash flow, and how metrics connect to strategic decisions. Question 4. How would you explain a forecast variance to a senior Verizon executive? I would begin with a concise headline. What changed, by how much, and whether it affects the full-year outlook. Then I would decompose the variance into volume, price, mix, timing, and cost drivers, distinguishing one-time items from structural trends. For example, lower revenue could reflect delayed activations rather than lost demand. I would quantify the recovery opportunity, identify accountable owners, and recommend actions. Executives need an accurate explanation, not merely a reconciled number. Be sure to mention materiality, root cause analysis, volume price mix decomposition, timing versus structural issues, quantified outlook impact, concise communication, and specific corrective actions. Question 5. How would you evaluate a Verizon 5G network investment? I would evaluate the investment using incremental cash flows, not total network economics. The model would include equipment and deployment costs, maintenance, spectrum-related expenditures, incremental subscribers or ARPU, enterprise revenue, capacity savings, taxes, and working capital. I would calculate NPV, IRR, and payback under multiple adoption scenarios, then assess strategic benefits such as network quality and competitive positioning. After approval, I would establish milestones and compare actual customer and financial outcomes with the investment case. While answering, focus on incremental revenue, avoided costs, capital requirements, useful life, adoption assumptions, NPV, IRR, payback, strategic benefits, downside risks, and post-investment performance tracking. Question 6. What is the difference between EBITDA, operating cash flow, and free cash flow? EBITDA measures operating earnings before interest, taxes, depreciation, and amortization, so it is useful for comparing operating performance but ignores major cash requirements. Operating cash flow starts with accounting earnings and adjusts for non-cash items and working capital movements. Free cash flow generally subtracts capital expenditures from operating cash flow. For Verizon, that distinction matters because network investment is substantial. A business can report strong EBITDA while generating weaker cash if capex or working capital rises. Make sure to cover operating profitability, non-cash expenses, working capital, taxes, interest, capital expenditures, limitations of EBITDA, and why free cash flow matters for Verizon's funding and leverage decisions. Question 7. How would you assess the profitability of a wireless customer or plan? I would calculate contribution economics by customer cohort and plan. Revenue would include recurring service charges, add-ons, and equipment-related economics, while costs would include acquisition commissions, device subsidies, network usage, billing, support, and retention offers. I would incorporate churn to estimate customer lifetime value and compare it with acquisition cost. A plan with higher ARPU is not automatically better if it carries excessive subsidies or churn. Cohort trends would reveal whether profitability improves as customers mature. In your answer, talk about customer lifetime value, ARPU, churn, acquisition costs, device subsidies, commissions, network usage, service costs, retention spending, contribution margin, and cohort analysis. Question 8. Tell me about a time you challenged a business partner's financial assumption. In one planning cycle, a commercial leader assumed a promotion would generate significant incremental volume based on an unusually strong pilot. I listened to the rationale, then tested the assumption against comparable cohorts, cannibalization, and expected subsidy costs. My analysis showed attractive gross additions but limited incremental contribution. Rather than rejecting the proposal, I recommended a smaller launch with measurable checkpoints. The leader accepted the approach, and we used actual results to refine the broader rollout. Be sure to mention respectful communication, evidence, scenario modeling, listening first, quantified impact, alignment on facts, and a resolution that protected the relationship and improved the decision. Question 9. How would you manage Verizon's annual planning process? I would start by translating corporate priorities into measurable financial and operating targets. Then I would establish a clear calendar, assign driver owners, provide standardized templates, and collect bottom-up plans from business units. I would reconcile those plans with top-down expectations, challenging unsupported assumptions and highlighting trade-offs between growth, margin, and investment. Multiple scenarios would show flexibility. Throughout the process, I would maintain decision logs and review milestones so the final plan remains owned, credible, and actionable. While answering, focus on calendar design, strategic priorities, driver ownership, bottom-up and top-down reconciliation, review cadence, scenario planning, accountability, and transparent communication of trade-offs. Question 10. How would you prioritize capital allocation between network investment, customer acquisition, and debt reduction? I would compare each use of cash on a risk-adjusted basis while preserving required liquidity and service quality. Network investment may support capacity, reliability, and future revenue. Customer acquisition can accelerate growth but may have uncertain payback. Debt reduction lowers interest and refinancing risk. I would rank initiatives by NPV, strategic necessity, execution confidence, and timing. I would also test downside cases, because a slightly lower return with stronger resilience may be preferable when leverage or market conditions are challenging. Make sure to cover strategic alignment, risk-adjusted returns, regulatory and service requirements, liquidity, leverage, hurdle rates, timing, scenario analysis, and the opportunity cost of each alternative. Question 11. What financial controls are most important in a large telecommunications company? I would prioritize controls over high-volume revenue, billing interfaces, cash receipts, capital projects, vendor payments, access rights, and significant estimates. Key controls include reconciliations between operational and general ledger systems, approval matrices, segregation of duties, journal entry review, capitalization testing, and documented account certifications. I would assess both design and operating effectiveness, investigate exceptions promptly, and retain clear evidence for audit and SOX requirements. Strong controls should protect reporting integrity without unnecessarily slowing the business. In your answer, talk about revenue completeness, billing accuracy, capitalization, procurement, access controls, reconciliations, journal entries, estimates, segregation of duties, SOX compliance, and audit evidence. Question 12. How would you investigate an unexpected decline in wireless service revenue? I would first validate the data and reconcile reported revenue to billing and general ledger records. Next, I would decompose the decline into subscriber volume, churn, ARPU, plan mix, discounts, credits, and timing. I would compare trends by geography, channel, customer segment, and cohort to isolate the issue. Interviews with commercial, billing, and operations teams would test the story. Finally, I would quantify whether the decline is temporary or structural and update the forecast with documented actions. Be sure to mention data validation, subscriber movements, churn, ARPU, plan mix, discounts, billing issues, timing, geographic or channel analysis, management interviews, and reconciliation to reported results. Question 13. How do you use data and automation to improve finance performance? I look for repetitive processes where finance spends time moving, formatting, or reconciling data rather than interpreting it. I would standardize definitions, create controlled data sources, automate recurring reports and variance bridges, and add validation checks before outputs reach management. For example, an automated subscriber to revenue reconciliation could reduce close effort and identify exceptions earlier. I would measure hours saved, error reduction, and cycle time improvement, while retaining human review for judgmental estimates and material decisions. While answering, focus on eliminating manual reconciliations, standardizing data, automating recurring reporting, improving controls, enabling self-service analysis, validating outputs, and freeing analysts for higher-value business partnering. Question 14. How would you manage a team during a demanding forecast or close cycle? I would set priorities early, define ownership, and distinguish essential deliverables from lower-value requests. A short daily cadence would surface blockers, while review checkpoints would protect accuracy before deadlines. I would rebalance work based on capacity, escalate unresolved data issues quickly, and remain available for judgment calls. After the cycle, I would conduct a retrospective, recognize strong performance, and convert recurring problems into process improvements. Effective leadership means delivering results without normalizing avoidable burnout or control failures. Make sure to cover workload planning, role clarity, prioritization, communication cadence, quality reviews, escalation, coaching, recognition, and maintaining control discipline under deadline pressure. Question 15. What would you do if Verizon's forecast missed its EBITDA target late in the quarter? I would quantify the gap and confirm that it is not a data, timing, or classification issue. Then I would separate committed results from controllable opportunities, such as discretionary spending, campaign timing, vendor actions, or productivity measures. I would avoid actions that merely shift costs or compromise customer experience and controls. I would present leadership with realistic scenarios, probabilities, and consequences, clearly communicate the updated outlook, and establish owners for corrective actions and tracking. In your answer, talk about validating the gap, separating controllable and uncontrollable drivers, assessing timing, updating scenarios, identifying ethical actions, protecting long-term value, and communicating transparently. Question 16. Explain how working capital affects Verizon's cash flow. Working capital changes can materially alter cash generation even when earnings are stable. Higher receivables consume cash, while stronger collections release it, Inventory builds consume cash, and supplier payables temporarily provide funding. In Verizon's context, device volumes, customer billing, promotions, and vendor terms can create meaningful timing effects. I would monitor aging, forecast collections and purchases, and distinguish sustainable improvements from one-time timing benefits. The objective is better cash conversion without harming service levels or key supplier relationships. Be sure to mention receivables, payables, inventory, contract assets or liabilities, collections, payment terms, device cycles, seasonality, cash conversion, and the balance between liquidity and supplier relationships. Question 17. How would you evaluate a cost reduction initiative without harming customer experience? I would begin by understanding the cost baseline and the service outcomes customers value, such as network reliability, response time, and issue resolution. I would prioritize structural productivity, process simplification, automation, and vendor optimization before broad cuts. Each initiative would include implementation costs, savings timing, service risk indicators, and accountable owners. I would pilot material changes, monitor customer and employee metrics, and report recurring savings separately from one-time benefits. Sustainable efficiency should strengthen economics without weakening the customer proposition. While answering, focus on baseline costs, service level metrics, customer impacts, root causes, productivity opportunities, implementation costs, risk controls, pilot testing, and measuring recurring versus one-time savings. Question 18. How do you communicate complex financial information to non-finance leaders? I start with the business question and the decision required, not the accounting detail. I use a simple bridge or chart to show the few drivers that explain the result, then translate those drivers into operational and customer implications. I avoid jargon and separate facts, assumptions, risks, and recommendations. For a senior leader, I might lead with a 3-line conclusion. For an operating team, I would provide more detail. I always confirm alignment on actions and ownership. Make sure to cover audience needs, plain language, visual storytelling, business drivers, implications, decision requests, avoidance of jargon, confirmation of understanding, and tailoring detail to the stakeholder. Question 19. Describe a financial model you built and how you ensured it was reliable. I built a multi-year model for a product expansion that linked customers, pricing, churn, operating costs, capital investment, and cash flow. I separated inputs, calculations, and outputs, used consistent definitions, and reconciled historical periods to actual results. I tested formulas, reviewed extreme scenarios, and had an independent colleague challenge the logic. Documentation and version control made changes traceable. The model helped leadership compare launch timing and investment levels, not simply produce a headline forecast. In your answer, talk about model purpose, input integrity, transparent formulas, historical validation, sensitivity analysis, review procedures, version control, documentation, and how the model supported a business decision. Question 20. What would success look like for you in your first 90 days at Verizon? During the first 30 days, I would learn Verizon's strategy, organization, systems, reporting definitions, and key business drivers while building relationships with finance and operating partners. By 60 days, I would assess forecast quality, close processes, controls, team capabilities, and recurring pain points. By 90 days, I would deliver one practical improvement, such as a clearer variance dashboard, and present a prioritized roadmap with owners, milestones, and expected value. Success would mean credibility, insight, and measurable momentum. Be sure to mention relationship building, understanding strategy and systems, learning key drivers, assessing processes and controls, delivering an early win, developing the team, and creating a prioritized improvement roadmap. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.